The dominant story within private capital over the past decade has been that of exceptional growth. Over the past 5 years in particular, there's been a huge spike in activity across every asset class, with the amount of annual capital raised, investor participation and deal volume all reaching record highs. As a result, private capital assets under management have reached $6.7 trillion as of June 2019, up from $2.4 trillion 10 years earlier. This is a trend that we expect to continue into the future, as we predict that the size of the industry will exceed $9 trillion by 2023. But what is driving this growth? One of the key factors underpinning this trend has been increasing demand from investors. Historically, private market investments were a choice reserved for only the most sophisticated and largest institutional investor. However, in recent years, alternative assets have grown to become a mainstay of the modern investment portfolio. And today, 4 out of 5 institutions are active within private markets. And when we talk about institutional investors, we mean everything from single-family offices, through endowments and foundations, to pension schemes, both public and private, all the way through to the largest sovereign wealth funds in the world. Investors have flocked to private capital for a number of reasons. Firstly, diversification underpins the surge into alternatives for all investors across all asset classes. The global financial crisis in 2008 proved the need to diversify away from traditional products and markets, and this need has fueled the growth we have seen globally over the last decade or more. With investors looking to alternatives to diversify exposures and also to diversify return streams, it's unsurprising we've seen allocators build complex portfolios comprising several different alternative asset classes in recent years. Another key theme within private markets is that of fragmentation. If you were to look at private capital industry 10 years ago, the vast majority of activity would have been fairly mainstream. Most investments were made into commingled funds, and strategies such as private equity buyouts and core real estate dominated the market. The industry today is very different. Nowadays, there are a wide range of different strategies and fund types competing in the market. Recent years have brought even more rapid change to the private capital industry. We've witnessed rapid modernisation in emerging economies like China and India, a technology boom, and a rise in responsible investing. The private capital industry has witnessed a large influx of capital from investors over the past decade. Aggregate annual capital raised by private capital funds has increased almost threefold in that time, from $326 billion in 2009 to $969 billion in 2019. As a result, fund managers have more capital available than ever before. Deal volume has surged over the past 5 years, with almost 33,000 private capital deals completed in 2019 alone. So while it's clear that the long-term prospects for the industry remain positive, we've seen several fund managers reduce their target returns for new funds, which begs the question, are the high returns achieved over the last 10 years sustainable over the next 10 years? And if not, will we continue to see the record levels of capital flowing into the industry? While we certainly do not expect to see a huge fall in demand from investors, what we may start to see is some of these trends levelling out over time, particularly if markets prove challenging.